broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. And it's a full house today. Prashant here. Sonia is back with us after a brief break. She was dealing with some illness. And Nigel, of course, with us as well. Morning, guys.
Good to have you back, Sonia.
Thank you. I'm glad to be back and glad to be here with you guys. And also, COVID's also back. So, but I mean, it's not so bad this time around. The strain is pretty weak. Thank God for that. But yeah, good to be back.
Good to have you back here, Sonia. Let's just quickly run you through the setup then, right? So things are looking a little better. And I've been saying this for the last 2 days. Actually, last Friday was a little panicky for global markets, especially European markets, because there was the weekend. Last 2 weekends, if there were anything to go by, something could have happened. Nothing happened. So Sunday was uneventful. Yesterday morning was uneventful. I think we're kind of continuing that repair. So U.S. markets broadly ended higher. You could argue with the fact that NASDAQ was down a little bit, 0.3, 0.4% or so. So it's a bit of a reversal of what has done very well this year so far, which is tech and communications. And they reversed. There was a bit of role reversal, but that's just one day. But if you look at the aggregate bigger indices, the U.S. did quite okay. The changes are on your screen. By the way, after all that has happened, the S&P 500 remains above where it was prior to the SVB bank collapse. And the index has been stuck in a range of between 3,800 to 4,100. So we are still muddling through that range. Banking worries in Europe also presumably eased a little bit. We can only kind of decipher, of course, with what's happening with prices. So the Euro Stoxx 50 index, which sold off 2% on Friday, it came up about nearly 1% last night, which is Monday. U.S. Treasury yields surged, and I was saying this yesterday that maybe for the fourth or fifth time, markets are once again underpricing what the Fed will do. Yields had dropped as of sort of Friday's close. The U.S. 2-year had dropped from 5.08% to 3.3% or so. It was just massive. It's what's happened is the market is kind of quickly trying to price things back in. So the 2-year yield went up 24 basis points. It hit the 4%, slightly above the 4% level, and stopped there. This is important for trajectory market expectations of what the Fed is likely to do going forward. Markets here yesterday, saw indecisiveness and ultimately they disappointed. So you see that surge which came through mid-afternoon, but starting about, 240 or so, the market sold off and ended absolutely flat. So that's the nifty for you. Banks, of course, ended in the red. Near-term resistance for the market, I think the levels have not changed. They're pretty much the same which what we put out yesterday because the changes yesterday were so small. Near-term resistance for the Nifty are at 17,207. And then the 20-day moving average, which comes in at 17,252. These are very near-term levels on the upside. On the downside, I think the big hope is that 16,800 holds. That's 16,800, 16,850. The low was 16,828. And then twice the market bounced from those levels. So not very far away. One day of selling will do it. So if we do see a retest, let's hope we're third time lucky. The levels are held. For the Bank Nifty, on the downside, the levels to protect are 38,942 and then the low of 38,613. Both which need to be held. These are lows from the 16th of March and the 20th of March. The market bounced big time from the lows of 16th of March. The 20-day for the Bank Nifty stands at 40,102. Again, very near-term levels on the upside. And then the high of 40,201 are very near-term resistance levels to watch out for. But as I said yesterday, it looked a little sort of better. It has looked a little better, but ultimately the market did not go anywhere and ended with about a 25 odd point change. SGX this morning is indicating about a 50-point higher start. Sonia.
Absolutely. And as you said, range bound, right? Last week when I was tracking the market as well, the market was at these levels, 16,900 to 17,000. So nothing much has changed in 1 week. So very, very range bound for the market. It's just that now I think a lot of people believe that maybe the worst of that whole SCB issue is now behind the market, global markets and local. So I guess that's something that, the street definitely likes. The Dow was up almost 200 points yesterday overnight. And it's been 3 straight days now that the S&P 500 is also in the green. So in that context, perhaps the worst of the global fears have now subsided and the market has moved on. But what happens from here on? We were talking about some levels. The 24th March low of 16,930 is something that the market has held on to. The recent support has been somewhere around 16,800, 16,900. So that will be a crucial line in the sand on the downside. And a lot of things to watch out for. There's the monthly expiry tomorrow. There is a market holiday on Thursday, so it is a truncated week in that sense. And a lot of big events coming up now. There is the auto sales that comes up. It starts on Saturday. So we'll be tracking that very closely. Then there's the Q4 earnings season as well. There's an RBI MPC meet too. And the earnings season begins on the 13th of April. So you have Infosys followed by HCL Tech and then a lot of big banking earnings like ICICI Bank, etc. So it's going to be an action-packed next fortnight for the market. Up until then, I guess this range is something that the market will maybe hold on to for the lack of any major triggers on the upside.
Well, that's right. Sonia, on closing bell, we make this point that participation looks like it's muted. But yesterday was clearly indicative of the kind of participation we had. It was a very, very boring session, actually, so to call it. So participation was muted, and we keep tracking the index. Like Sonia mentioned, last week we were at around the 16,900, around 17,000 odd. The problem is the small cap index. Now, in 2 sessions, it's lost close to around 2.5% odd. And now from the 52-week high, it's down close to around 20% odd. Talk to a lot of people who are investing in the market. The point is not about the small cap index. Some of those small cap stocks, they are half or even fallen more than that. So that entire COVID rally that we had, plenty of the stocks have given away most of what they put on. We've been talking about the short covering bounce, and it did come about, but it had very little impact actually yesterday for the bulls, because you have the kind of short covering that we saw. Well, you would expect the market to be up and about. The Nifty Financial Services expiry, well, that's today, and tomorrow you have the entire monthly expiry that plays out. So a couple of sessions, we'll see rolls pick up as well and expect some bit of volatility as well. I hope we don't have as boring a session as we had yesterday. Now, in terms of participation, the institutional participation itself is much lower. Both the DI and the FI participation was down 20 to around 30% if you compare it with the March gross volumes itself. Now, the Nifty premium, the March contract which will expire tomorrow, that stood out yesterday because you had close to around 10 rupees of premium. It went sunny to around 50 rupees odd. That told you either there was long addition or big short covering. And that's what the FIs did. They added longs yesterday. They covered more than 30,000 short contracts. And that's why the net short positioning has come down drastically. Just last week, it was closer to around 200,000 contracts on the short side. That's the net short contracts. Well, that's come down to less than 150,000 now. In percentage terms, it's come down from around 91, 92% to around 82%. So that big short covering bounce, some part of that has played out, but it's had very little impact on the index. On the index option side, well, the FIs, they bought more calls than puts, but they're writing both calls as well as puts. You're not getting big direction out there. 2 strikes I want to highlight, 17,000 put and 17,000 call. There appears there's a short straddle taking place out here. That means you're writing the call as well as the put at around 17,000 odd, and you're bracing for a broad 300-point range with the expiry that plays out tomorrow because Thursday is a holiday. The Nifty Bank is going to be very, very crucial. Yesterday, it went almost to around the 200 DMA, but it couldn't conquer that. So the Nifty Bank moving to that 200 DMA, that's something that the bulls want. And if that happens, then you could brace yourself for a good session. Otherwise, till that happens, you have a large percentage of the index that's not moving. So this bounce that we're seeing, we need to see it sustain, and you need to see the Nifty Bank go to around that 200 DMA. Let's see how this one plays out, Sonia.
All right, Nigel, I said this 2 days back. This is a kind of a market, Nigel, where if you have a bullish view and a bearish view, both are likely to be correct in the same day. I mean, you'll be proven right. It's just another matter that when you're trading, it is extremely difficult. Except right out of the gates, if you got a big gap down or a big gap up, you can do something.
Yeah.
But in the middle of the session, it gets very hard because, just take a look at yesterday's session. We were up and about, flying 140 points higher, and by close we end with a 20-odd point, whatever.
So very volatile. But one thing is there. Last week, if you folks remember, a fortnight ago, we were all talking about this. These words, recession, everything was coming up. 2008, Lehman, and that subsided so far.
The words which were coming up was no 2008, no Lehman. The message at least here was very clear that it is this is not Lehman.
But there was some amount of fear, and that has subsided really fast. I mean, SVB seems like a long time ago.
Yeah, and it's not had any significant stock market impact in that sense. Banks, of course, have sold off, and regional banks, but larger banks are right there. The S&P is right. It's above where it traded when the SVB crisis actually happened
for
2 weeks ago.
For this month, in fact, you have the US markets that are positive with all the news flow.
Exactly. So, well, that's markets for you. Before we start and go any further, let me quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Mark Matthews of Bank Julius Baer and Company will join in to discuss global trade setup. Our research team will get you the top list of stocks to watch. The team is watching. And of course, Hemang Jani is the fundamental stock analyst today who will talk to us about what he's making of the markets.
Okay, well, we have two interesting equity and commodity views for you this morning. On the equities front, we have Sridhar Sivaram of Enam Holdings, who says that they have been cautious for the last 18 months and continue to believe that this is going to be a very tough year. He says when interest rates rise in such a short period, it normally ends up with some accidents. He adds this is a very stock-specific and bottom-up market, and this is not a time to be aggressive. He also says smaller US banks are seeing a deposit reduction, and it is difficult to say how this is going to play out. He continues to like financials despite bank stocks not doing well.
Okay, we are also getting in a quick take on gold this morning from Lawrence Belanco of CLSA. He says gold is worth monitoring as price action is approaching key resistance of $2,063, $2,078 an ounce. From a longer-term perspective, he says this trading range sets the platform for a breakout in the upside if levels of $2,063 are taken out. Lawrence adds that the next level to watch on the upside is $2,500 to $2,530.
All right, we have a lot of stock-specific action that we're going to track for you, and we'll get to that in just a bit in our special Top 10 segment, where we're looking at Adani Power, Paytm, Aditya Birla Capital, you have Phoenix Mills, All Cargo Logistics, PNC Infra, Dilip Bilcon, ONGC and Oil India. Their stocks on the back of positive news flow, while you have large trade that could take place in Kalyan Jewellers, and that's the lone stock that could be reacting to negative news flow.
Okay, so that's about the stock-specific action. We'll get to that in a bit. But in the meantime, let's get you a quick update on what happened overnight in the global markets as well. Some important opinion coming in from Allianz Chief Economic Advisor Mohammad El Arian on the banking crisis unfolding in the US, the economy, the Fed, and the impact all of this would have on global markets.
I suspect the least bad is a pause after the hikes we've seen, make sure that the financial contagion is behind us, and then try to assess the economic contagion, which is harder to counter with policy. And then try to resolve, Joe, this big difference we have between what the Fed is telling us is going to happen to rates and what the markets think. We need to resolve this, because the longer it stays unresolved, the bigger the problem when it has to be resolved. That is the most important question right now, the degree of economic contagion that resulting from this mishandled interest rate cycle. Look, it is going to be significant because there are two different drivers here. One is banks themselves getting more conservative, but two is bank expecting regulation to get tighter. The regulators and the supervisors have been embarrassed. And the response has always been tighten regulation more, even though this is a failure of supervision more than it is a failure of regulation.
Okay, well, mistimed interest rate hiking cycle. That's how Elarian puts it. Mark Matthews of Bank Julius Baer and Company is joining in. Mark, good to have you back on the program. Thanks very much. Here and now, are these global banking worries receding a little bit?
Apparently, the company that bought Silicon Valley Bank yesterday, this company, First Citizens Bancorp, its share price was up 53% last night. So that's telling you the market thinks that issue has been resolved.
Okay, that's what we were just discussing a while back as to how now SVB, the whole issue seems like it was a long time ago. And India definitely has, come out strong. There's not been too much of a hit here. But how are you feeling about the Indian market now? We have earnings season upon us. The market has been in a really tight range. Do you see any reason for this range to break out either way?
Yes, I think the dollar could be very helpful to India because the Fed is definitely, if not at the peak of the rate hike cycle, then extremely close to the peak. And as Mohammed Al-Aryan said in your clip that you just played, the market thinks that U.S. rates will be substantially lower by the end of this year. On the other hand, you have the Eurozone where they're going to be publishing their inflation this coming Friday. And if the consensus is correct that their core inflation, CPI inflation is 5.7%, that will be higher than U.S. core inflation. And I think will cause some repricing of the euro. And the euro is 2/3 of the dollar index. So I think the dollar will continue to slowly decline, barring an enormous banking crisis. And then, I think it would probably be going up as a risk-off kind of thing. But that's not our base case. And of course, when the dollar falls, that's a great tailwind for the Asian markets, including India.
Hi, morning, Mark. Yeah, that's good news, right? If the dollar index can cool down, then that's a tailwind for emerging markets as well as India. But how do you approach the Indian markets from here on, Mark? And what would you like to buy here in the Indian markets? The banks, well, they were a consensus buy, but they have corrected a fair bit. Is that a pocket you like?
Yes, we haven't changed our view on them. We like them. I think that every market in the world, it won't go up or down in a straight line. They aren't linear and they chop around. Sometimes they can go sideways for quite a long time. So I'm not at all disconcerted by India's underperformance so far this year, despite the fact everybody seems to be talking about it. You have to remember last year in relative terms, it did well compared to most other markets in the world. And the year before it did very well. So it won't always be outperforming. And this could be a year where it underperforms some other markets. But I haven't changed my opinion at all. We like banks, and I think the Indian market is fine.
Indian market is fine. Actually, the index has not seen too much damage, Mark. The broader markets have naturally seen more. There is that kind of dispersion always which comes up. Mark, but out of Europe, what's the view with Deutsche Bank? And when I mentioned those banking worries, there's a question first up. I had more Europe on mind than US. So any thoughts there?
Yes, I think that the problem isn't really in Europe, it's in America, just because of the structure of the banking sector. In Europe, you don't have these small, almost pound-sized banks that you do scattered across the United States. I mean, there are some smaller regional banks, but they're not nearly as important for the economy, for the banking sector as the big banks are in Europe. And because they went through the global financial crisis and then their own European crisis, the banks there are sufficiently capitalized. And I wouldn't worry about it. And whatever Deutsche Bank's CDS spread is right now, I don't know, but never got anywhere close to where Credit Suisse's was.
Okay, all right, Mark, we'll let you go on that note. Thanks a lot for joining in, and good to know that after everything, India is still one of your preferred markets, and the banks is the space that you want to be in the Indian markets. Thanks a lot for being with us. Well, that's Bank Julius Baer and Company. Let's slip into a quick break. On the other side, our list of top 10 stocks with our entire research team coming up, so don't go anywhere. Welcome back to Bazaar Morning Call. This morning, the cues are in the green. So most of the global markets had a green touch to them. The SGX 50 is also up 50 odd points. So let's see which way it goes. Many stocks in focus this morning. So let's get our entire research team on board. Vivek is joining in first up to tell us about Adani Power and why he's watching that one. Vivek, good morning.
Well, good morning. Some positive news flow coming in as far as Adani Power is concerned. The Supreme Court has gone ahead and dismissed the Customs Department appeal against Adani Power Maharashtra and two other entities, which is Adani Power Rajasthan as well as Maharashtra Eastern Grid Power Transmission. Now, remember, the Customs Department had earlier alleged that there was an overvaluation as far as import of certain capital goods as far as Adani Power is concerned. However, the Supreme Court has actually found that the Adani Power bid was actually lower than the benchmark per megawatt cost that was fixed by CERC, the appellate tribunal. So on the back of that, expect some positive as far as Adani Power is concerned.
Okay, all right, Vivek, thanks so much for that, and good to have you back as well. Well, let's hop across to Abhishek. He's tracking two stocks, AB Capital as well as Paytm. Morning, Abhishek.
Morning, Nigel. To begin with Paytm, KYC wallet customers can make payments, on Paytm Payment Bank that will earn additional interchange revenue from merchants acquired by other payment service providers, payment gateways, as well as payment aggregators. So bank will earn, Paytm Payment Bank will earn 1.1% as interchange revenue, about 15 basis points for charges for adding more than rupees 2,000 to UPI, and 15 basis point when other wallet will be used to add money into the bank. So NPCI had announced wallet interoperability guidelines as of March 24, 2023. Morgan Stanley has written on Paytm they have an equal weight rating, target price of 695 per share. They say that for payments bank, the new guidelines could lead to additional revenues. New guidelines could also lead to some higher wallet loading charges, and Paytm should benefit as interchange fees paid to Paytm payment banks actually moves lower. Aditya Birla Capital, they are selling their stake in Aditya Birla Insurance Brokers to Samara Capital for an enterprise value of rupees 455 crore. Now, AB Capital holds about 50% stake in the company, and company says that it will receive further consideration post the completion of 5 years from the deal closing. We have Morgan Stanley who has written a note on this AB Capital. They have an equal weight rating with a target price of 163 per share. They said that the broking arm sale is at 60% discount to their own valuation that they had given. So entire subsidiary is being sold for 455 crore, implying the valuation of just 5 times FY24 profits. So broking arm contributes about 2.4 per share, about 1.4% of the total, to their target price of 163 per share. Back to you.
Okay, thanks a lot for that. So that's AB Capital in focus. But Kalyan Jewellers also on our radar, as Warburg Pincus is looking to sell some stake there. Vivek has details on that. Vivek, over to you.
Well, that's right. So Kalyan Jewellers expect, some pressure at least in the early part of the trading session. What we understand from our sources is that Warburg Pincus, is looking to sell almost 2.5% stake in the company, and this is going to be via the block deal mechanism. Now, the floor price for this particular block is at 110 rupees a share, almost a 7.5% discount to yesterday's closing price. And remember, 2.5% stake out of the total 26.3% stake that the company had at the end of the December quarter. The total offer size works out to around 288 crore. And what we understand is that there is now a 60-day lock-in as far as further sale of shares by Warburg is concerned. It's going to be interesting to see how this particular stock reacts to the large block deal that's expected today.
Okay, all right. Thanks for that, Vivek. And let's wind this down then with Sonal, who's joining to tell us all the other stocks that are on the news. Morning, Sonal.
Good morning, Nigel. Let me start with Phoenix Mills. Again, it'll be in focus today because CPP Investments has completed second tranche of investment in one of its arms to the tune of 160 crore rupees is the investment here. CPP post this second tranche will hold 40.26% stake, and Phoenix Mills will hold 59.74% stake in the arm where they will be developing some malls. All Cargo, where they had entered into a share purchase agreement earlier, it has been executed now. It is between the company, KWE Singapore, KWE India, Gati Limited and GKEPL as well. This is for acquisition of aggregate 150,000 equity shares. That is a 30% stake in GKEPL. So that is the kind of share purchase agreement that the company has entered into. PNC Infra, they have bagged a new hybrid Anvity Highway project for a bid cost of 819 crore rupees. There's one more order win by Dilip Bilcon. They are the L1 bidder by NHAI on hybrid Anvity basis. The project cost here is 780 crore rupees.
Okay, thanks a lot for that. So plenty of stocks that are in the news this morning. But let's do one thing. Let's also talk about the commodity market and what's the latest that's happening in the world of crude. Manisha Gupta is here to give us a quick roundup of that. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, a smart rebound in the crude oil prices where we did see a low of $70, but we are holding around 78. So $8 of a jump up is what we've seen in last couple of weeks. Now, overnight as well, it has been nearly 4.5% of a surge. The latest trigger has been the legal dispute, which has halted nearly 400,000 barrels per day of an export from Turkey. Also, the nuclear war talk from Russia's president. Also, the Russian oil minister saying that the output export cuts are on target for the month of March. All have been been supporting the prices here. And then you also have seen the banking sector concerns ease. The buying has returned in risky assets, and the markets are looking at stronger demand coming in from China as well. All factors suggesting that we could be headed higher from here. $80 is now a psychological resistance for crude prices.
Okay, all right. Thanks a lot for that, Manisha. Well, here's a quick recap then of all the stocks that we just discussed with you. We have Adani Power, Paytm, Phoenix Mills, All Cargo Logistics, PNC Infra, Dilip Bilkon, ONGC and Oil India. Well, stock with negative news flow is Kalyan Jewella as well as Aditya Birla Capital. Well, time to slip into a short break, but when you come back, we'll discuss the fundamentals of the market and focus on various stocks. Hemang Jani of Motilal Oswal Financial Services will be joining in. Later on, we'll also talk with Shantanu Khosla of Crompton to discuss the details on the merger with Butterfly Gandhimati that was announced over the weekend. You stay with us. Welcome back. Hope you're having a good morning. For starters, the SGX Nifty suggesting that we're going to open up in the green. But remember, on a day-to-day basis, we do have a fair bit of intraday volatility. So let's hope, from a bullish perspective, that we can build onto those gains. But plenty of stocks to discuss, and to help us out with that, we're joined by Hemang Jani, retail equity strategist at Motilal Oswal. Hi, Hemang. Good morning. Thanks so much for joining in. Hemang, I wanted to ask you about Paytm. The stock is a third of what it was when it listed. But there is some positive news flow that's coming on there. You got those, NPCI, they announced that wallet interoperability guidelines, which could be good for them. Besides that, any view on the stock at current reckoning?
Good morning, Nigel. I think Paytm, if you see past few months, we've seen a good, pullback in the stock, and the data points, in terms of the usage and also the management commentary in terms of turning into, profitability much ahead of time is surely helping the stock, and it has done pretty well. I think the recent guidelines wherein the KYC related norms are relaxed could add to this positivity, and you might see some more upside, but this is the space where we are not too confident about in terms of how the market would take because of the way things have panned out over the last 1.5 years. So they do provide short-term opportunities for retail traders, 10-15%, and from that perspective, surely it's looking good. But we would avoid, giving a long-term view because of various moving parts.
Hemang, in your conversations, the way the market sold off yesterday, right? Anything? Is it to do with these tax changes? Are you hearing anything just in terms of market chatter, feedback? More money, at least in the next 1 week or so, going into debt funds? Locking in those rates. Anything you can tell us? Yeah, go on.
So, Prashant, I think if you see Bank Nifty has been underperforming for almost now about a month or so, and maybe partly it has something to do with what has happened in terms of this, capital gains, relaxation, indexation benefit which was there. But I do not think that would have a big impact on the market as such, and to some extent that is slightly positive for the banks. So in terms of flows, yes, it's possible that because the already rate of interest are higher and this new changes are going to be effective from 1st of April, some people may take advantage of that, so that might be a factor. But I think the reason why the market sold off yesterday has more to do with the fact that, you have an expiry, and this entire month, the Bank Nifty in particular has remained sluggish and it's underperforming. So I think you might see some sort of a base formation, maybe, in a couple of days, and we do expect some uptick because of the severe correction that we already gone through. And there is some degree of stability in the global markets. The contagion is not spreading. And we do think that this would provide a good entry point into some of the banking names.
Okay, a good entry point into some of the banking names. Got that. Anything else that you like, Hemang? What else would you buy in this market, either from large caps or mid caps?
So, Sonia, I think, we think that banks definitely would be on top of mind because of the severe correction. And we think that there is a fair degree of stability when it comes to earning. I don't think there's going to be any major negative surprises. I think auto is going to be a bit patchy because, this Gudi Padwa and the Navratra, the overall response that we've got from the channel checks has not been that great. Particularly Maharashtra, we haven't really seen any major positive surprise. The rainfall, which we've seen in Punjab, Haryana, etc., could have some negative rub off. The rural side is struggling. So auto is something that, we are not too positive, but maybe Ashok Leyland or some of the CV companies is where we are positively biased. We would avoid IT in a major way, but surely I think some of the pharma and the consumer names which have been laggards, I think you might see some, pop there. We've seen Aurobindo Pharma, Sun Pharma, pulling back very smartly. So I think because of that, you might see some stability and strength in some of these names.
Okay, well, stay on. We'll come back to you in a bit. For now, let's also talk to our corporate. Shantanu Khosa, the Managing Director at Crompton-Greaves Consumer Electricals, joins us now about the acquisition as well as the way forward. Remember, Crompton has announced the merger with Butterfly Gandhimati, and let's try and understand what the merged entity would bring about. Shantanu, if we look at the valuation at the time of acquiring Butterfly last year and the valuation being offered in the merger today, it's almost a 10% drop. I understand that market dynamics have also changed. While the CG consumer share has dipped more sharply this time around, that seems to be, a bit of a problem. Can you justify for us what the merger ratio is and how have you valued these two entities to arrive at this equation?
The valuation has actually been done by independent registered valuers. It was E&Y who did the valuation on behalf of Crompton, and PwC who did the valuation on behalf of Butterfly. And they submitted a joint valuation report to the boards of the two respective companies. They obviously used their own standard or methods to arrive at a valuation. Once they had a valuation, then this was actually a fairness opinion was provided on the valuation and the swap ratio by Kotak Mahindra Capital on behalf of Crompton and SBI Capital Markets on behalf of Butterfly. And this fairness opinion was provided by these two on the valuation which was delivered by EY and PwC. And this went to the boards of the two companies independently, and then the boards approved based on the valuations provided and the fairness opinions provided.
Are some of the smaller, Mr. Khosla, some of the smaller shareholders also on board with this, or do you foresee any opposition to this swap ratio at all?
No, we believe actually that this merger is beneficial really to all stakeholders, shareholders of both companies, and also other stakeholders, employees, customers, suppliers. And obviously, we believe that it's absolutely an appropriate and a fair swap ratio and evaluation. And we are very optimistic that this will be supported by the minority shareholders.
Okay, all right. We got that then, Mr. Khosla. Let's focus on the operational performance. Now, one of the reasons you're doing this is for cost synergies, right? How much have you realized till now? And what's the extent of cost savings you expect in the future?
We expect, as we had always expected, synergies in two areas. First, obviously, cost synergies, and the second is revenue synergies. So let me address them one by one. Cost synergies, we have actually been getting over the past 1 year as we've put in place various programs such as, for example, common purchase of commodities. So the scale enables us to get better pricing and things like that. Obviously, one of our reasons for recommending this merger is that we believe that once the two entities are merged, we will actually be able to accelerate our program of cost synergies as we move forward. It will move into areas such as, for example, supply chain, logistics, warehousing. Because the businesses are so similar, you won't necessarily need duplication of various elements in the supply chain. Secondly, moving on to what we think is strategically even more important, the revenue synergies. We expect the revenue synergies to start kicking in this coming fiscal and also accelerate as the two entities get merged.
So will the current manufacturing facilities be able to meet the combined needs? Just trying to understand, will there be any brownfield or greenfield expansion that you're looking at?
There are already certain opportunities which we are already beginning to work against. For example, Butterfly today has got unutilized capacity in mixies, while Crompton is manufacturing its mixies from a number of outsourced vendors. So bringing Crompton mixies in-house into the Butterfly manufacturing facility is a project which clearly immediately adds value. Beyond that, we are working on increasing and improving the capacity and reliability and quality of all our manufacturing facilities, both Butterfly and Crompton, by investing in automation, investing in improved processes, investing in more digitization in the manufacturing process. We are also moving, as we do this, to bring more production in-house. Finally, as we need capacity, we will continue to add over time greenfield as we see fit.
Okay. Mr. Khosla, can you quantify how many distributor networks have been added with this merger?
It starts off with a combination of existing Butterfly and existing Crompton appliance distributors. So if in a particular city, I have got 4 distributors of Butterfly and I've got 3 distributors of Crompton appliances, not necessarily fans, I would automatically then have 8 distributors for the combined business. On top of this, I will have to add and strengthen more distributors if I want to grow to a leadership position. This is a step-by-step process, which we're beginning in the West and the North, starting April, May, June. As we learn from this, and as this merger, when it gets approved and formalized, it will help us accelerate this process of expansion.
All right, we're almost done with FY23, sir. What kind of a revenue growth are you working with for FY24?
The best way and, the fairest way I would define our objectives would be to grow a couple of points faster than the market in all the segments we operate. Some a little more so, like appliances. And the reason I put it reference to market is because there's still certain uncertainties about market growth rates, etc., looking forward on the next 12 months. But if I look on a more long-term sustained basis, I think we are talking about growth rate in the low teens as a bare minimum.
Okay, what kind of margins are you expecting? I mean, what could the margin profile be, just to understand, post the merger?
See, the EBITDA margin right now for Crompton is in the range of 13 to 15. And in Butterfly, we have already improved it from a historical 6, 7 to about a 9 or 10. We will continue to gradually grow the Butterfly margin. However, again, I don't want to commit to a number because our focus is really going to be more in the initial years to take the synergy benefits and reinvest it in growth.
All right, Mr. Khosla, thanks so much for stopping by and giving us all of those details. Wishing you all the best for FY24. Well, Hemang Jani as well is with us. Hemang, I want to discuss a couple of stocks with you from the cement pack. That's CCC and Ambuja Cements. Now, yesterday, Ambuja Cements, they put it on the exchanges, a presentation as they're meeting investors in Hong Kong as well as Singapore, and they're giving them the roadmap with the medium to around the long-term view. So in terms of capacity, they are committed to doubling capacity to around 140 million tons odd. But they've also given projections about how they expect the coming years to shape up. That's 2023, and they're saying that by 2028, they have a bit of a vision. Now, the capacity expansion will be both greenfield as well as brownfield, but they're saying most of it is likely to be organic in nature, and they're going to be spending close to 46,000 crores odd. Just pull up a quick couple of numbers. ROC, they've given the improvement out there. The EBITDA per ton from around 1,000 rupees, expecting it to go to around 1,400 rupees odd. And this is predominantly going to be led by synergy benefits with the parent company and 300 to 400 rupees EBITDA per ton improvement they're talking about in FY24 itself. The reasons they've stated out is, waste heat recovery system, higher renewable power, entering into long-term fly ash contracts and the likes. Basic thing is that they're looking to improve the EBITDA per ton by 300 to 400 rupees. We have a couple of brokerage reactions. Morgan Stanley, they're saying they've given some direction in terms of their path, but there's still plenty of uncertainty in terms of the expansion, and they need more clarity about this EBITDA per ton improvement. So it seems they're not convinced. JP Morgan, they're finding these assumptions too optimistic, and they had joined us last week, and Pinakin Parekh said that if there's going to be higher capacity addition by Ambuja Cements, it may not be very, very good news for the industry on the whole, because it'll put pressure on pricing as well as profitability. Hemang, well, that's what a couple of brokerages have to say, and that's the vision of Ambuja Cements. What's your view on the stock, both these two? Yesterday, this in fact came in market hours, but the stock didn't react at all. Ambitious plans, or you think it's gettable?
So, Nigel, 2-3 things I would like to highlight here. One is that, yes, definitely the plans are looking, aggressive. Secondly, there is an impending block sale which has to happen, and it remains to be seen finally, the slight dilution that Adani Group is looking at, how it actually happens. Thirdly, we have seen, Nigel, that the raw material prices have corrected in the past 3 to 4 weeks. And whatever EBITDA per ton guidance that the management has given, I think in the context of the raw material prices cut is looking far more realistic. So we think that given that the capex is a very big theme, and there has been some sort of a consolidation and cost synergies that the company will be able to achieve, definitely it would be it would have some positive repercussions. But at this point, we prefer Ultratech and Dalmia Bharat compared to an Ambuja because of the kind of valuation and the overall growth potential that we see for those two companies.
Okay. I also wanted your thoughts on, there's a news report which suggests that the cabinet is set to adopt a gas panel report this week itself. And this is, of course, for the gas price, APM gas price revision that happens every 6 months. But wanted your thoughts on how one should approach if they do have MGL or IGL in your portfolio. What would the impact be?
So, Sonia, I think, once this new guidelines are implemented, surely I think for the gas distributors, it would be positive because we have seen a big sell-off in the, spot gas prices. And we think that though there may not be a significant margin improvement because they have also taken a corresponding price cut, but the volume, story is going to be intact. And within the gas utility space, what we prefer is Gujarat Gas and MGL. IGL is something that we find a bit more expensive. So I think a relative, preference would be towards the other two names.
All right, Hemang, stay with us. We'll take a very quick break here. But as we do that, let me quickly tell you what's lined up here in the next 30 minutes of trade. Anu joins in with a quick trade setup. We'll get you the top picks of the day with our technical and F&O experts. After that, the Momentumizer stock for today will get you that. And at 9:10, Nimish will be here with a standout brokerage report of the day. So that's basically what you have coming up in terms of the lineup all the way leading up to market open. Okay, the SGX is up on your screen, 50 points or so, 1/3% higher is what we have. Now, we look at the SGX every morning and we look at the market open and then we look at what happens during the course of the day. And things turn out to be pretty different. Yesterday was a case in point. Disappointing by close, we ended absolutely flat. Anuj is here in the studios with a quick check on what he's making of things. Anuj, hi, morning.
Morning, Prashant, Nigel, Sonia, good to have you back. It's maybe today is also going to be a repeat. It's just that kind of a market. It's just the weakness is clearly palpable. In fact, we have now 2 days of back-to-back expiry. Today is, of course, the financial nifty expiry, and tomorrow is the monthly expiry. And the trend is quite weak. And yesterday, all it needed was 5 minutes, between 3 and 3.5, to sort of spoil the entire day's good work and tell you the kind of market that we have. It's a sell on rally market till 17,225 is crossed, and shorts will not cover till that is done. In fact, yesterday's biggest worrying stat is that despite so much short covering yesterday, Nifty rallied all of 40 points. That tells you the kind of weakness that we are in right now. And Nifty is not even reflecting the true pain in the market. You look at portfolios, look at the broader market. Yesterday, advanced decline was 1:4. Now, 1:4 is as bad an advanced decline as it can get. Only on really bad days, you get to 1:6 or 1:7. 1:4 on a day when Nifty was up 40 points tells you the kind of market we are actually in. Now, because, today and tomorrow we are preparing for expiry, on the Nifty, you want to play the range. What is the range? Yesterday's high and low, so 16,918 to 17,091. I think if you play this range smartly, you'll make money. I mean, the effort should be to try and buy as close to 16,918 and sell as close to 17,091. On the Bank Nifty, today's financial Nifty expiry could make a bit of an impact. The range for the Bank Nifty, if you go by the options data, 39,500 put and call both have highest open interest and combined premium of 500 rupees. So it gives you a broad range of 40,000, 39,000 to 40,000. But if you want to play a smaller range, the smaller range would come in again between yesterday's range, so around 39,250 to 39,700.
All right, Anuj, thanks a lot for that. So very, very range-bound market, almost boring market is what we've seen the last few days. But we've had a fair share of entertainment a fortnight ago, so we're okay with boring for a while. Mitesh Thakkar and Sudarshan Sukhani join in now to tell us how to approach the day's trade. Gentlemen, morning to both of you. Sudarshan, is there any reason for this market to break out of this range? And what are the levels that you're watching out for today?
Yeah, good morning. See, we have a trading range that's now clear and visible. Any reason I can't say, Sonia, markets can find a reason to do something, but the probability of a break below the range is much stronger for me, which means sooner or later 16,800 could be taken out on the downside. That doesn't mean we can't break on the upside. It's just that as of now, the higher probability is a lower breakdown. Now, trading inside a trading range is always difficult, and usually, prices move randomly inside the range. I would suggest the same, give traders the same suggestion as yesterday. Try to avoid trading as much as possible. If you have to, then you buy on a sharp correction with a stop at 16,900. But if you can avoid it, nothing like it.
All right. Okay, Sudarshan, thanks for that. Mitesh, what about you?
Yeah. Good morning, guys. So we've been advocating that 17,100 and then 17,250, 280 is the zone where the markets will find supply. And 16,850, 16,750 are the two levels which are support on the downside. Now, having said that, we have also been maintaining that this will be choppy, but yet a ranged market with eventually a higher risk of us breaking on the downside. So I think that view still remains. Therefore, it becomes an ideal sell and rallies market, as Anuj was also highlighting. Close at about 17,100, 150, very good levels to start shorting on the index. If you get to about 17,250, and that is a big if, then I think we can do aggressive shorting in futures as well. But otherwise, we'll want to buy put options as we get some kind of a bounce back closer to about 17,100, 150 zones. And broadly, I think, once we start breaking 16,850, then I think we can look at about 16,500, 450 at least as the minimum target.
Okay, gentlemen, good morning. Mitesh, what about your trading calls?
Morning, Prashant. I have two buys and two sells. Bandhan Bank on a mild pullback today can be sold around 199, 200. Keep a stop at 205. Look for targets of around 190 here. Similarly, JNFC on any pullback, let's say 503, 505 is the good range to go short here. Keep a stop at 519. Look for targets of 575. So these are the two sell calls. On the buying side is Godrej Consumer. Keep a stop at 949. Look for targets of 988. And Dalmia Bharat is a buy with a stop just below 1850 for targets of 1915.
Okay, thanks for that. Sudarshan, how about you?
Well, DLF is an intraday short. The stock had big declines for the last 2 days. Something is going on there. So take an intraday short with a stop above 357. Dabur is a positional buy. See, there are no intraday trades for me in this very choppy market, but there are positional buying opportunities. And what's the harm? Traders should use this dip to buy good quality stocks. So Dabur is a positional buy. Keep a tight stop under 534. Last week also I had said that FMCG stocks are looking up. Now we don't know how much they will go, but it's worth going in if you have a medium-term view. Indigo is another intraday short sell. The stock was in a trading range and yesterday it broke down from that trading range. Keep a stop above 1826. And finally, Ultratech Cement, another positional buy. You know, if you buy these good quality stocks now, 1 year later, you will be much happier. Buy with a stop under 7,300.
All right. Gentlemen, thanks very much. We'll get back to you shortly with more in a bit from now. 5 minutes to go for the pre-open session. We'll take a very quick break. We come back with a pre-open. We also have Ankur Rudra of JP Morgan to discuss the latest trends in the telecom sector. Stay tuned. That conversation coming up next.